Welcome to today's session. Let's jump right into it here. I'm going to start out with direction alerts as we start out with a top-down approach. Top-down approach, we're looking at what's the market trend doing. We're looking at our long-term perspective, and we can utilize the direction alert tab on the market trend tab to start. We're going to be focusing on where are we at in the current trend. This bottom chart is a 20-year chart. The momentum chart is a 1-year chart, so we're just looking at current momentum in the past year, which is essentially just about this much of the current chart pattern of this 20-year time frame. So we know that we've been in an overall uptrend for 18 months, 24 months. We had COVID back here. We had the retracement, recession-ish from COVID. Now we're kind of getting this AI productivity boom that's been taking place. Those are kind of the real big picture market conditions. That's where we're at in the trend. We also know that momentum is at the top end of this trend in terms of where we're at in the extensions from a mean, essentially. So when we're talking about market trends and we're talking about can a trend be sustainable, typically stocks are sustainable and markets at a 45-degree angle on a stock chart, but you're going to get these overshoots up and maybe undershoots and then back up and then some support. You get these ranges where we can move up and down within an overall uptrend. And that's kind of where we're at right here is, are we going to retrace back down to a sustainable level at some point? It's going to happen. Does it happen higher? Does it happen lower sooner or later? That's a lot of the talking points that are being talked about going into the next few weeks are still growth of the economy. We're now starting earnings season, so we can start to see some of the profitability numbers that start to come in as well. In the shorter term, we're looking at momentum, breadth, and sentiment, all three showing here on this chart. Typically, when we do start to see some market trend reversals, we start to see that in the shorter term as well. And a couple of notes here is oftentimes you will see a volatility or a momentum spike into positive sentiment. So we're starting to see some of that sentiment relax a little bit, starting to trend lower while price is still heading higher, but we've yet to see a momentum spike. That doesn't always have to happen, but oftentimes it will happen. You'll get that last push higher. It creates a lot of liquidity for those that are looking to get out to sell. You get some of that institutional selling, looking for opportunities to sell, and maybe a push higher creates that extra liquidity for them to be able to do that. We haven't really seen that quite yet. At least in this, we haven't seen it. We may not see it, but often that does happen. We're seeing momentum pull back into still a sustainable trending location, and we're also seeing breadth weakening right here. It's about at par. We'll look at buy-sell ratio right here as well, and we're seeing sentiment. Sentiment had been just gradually drifting a little bit lower here around that 99 range. Still in the upper end of that range, though. We're looking at buy-sell ratio right at 1, close to at 1.02, which is essentially when these two are equal or very close to that. So are we going to get this move higher, this continuation of the green taking over, or are we going to get just a little pause right here and then get red to spike back up? One way or the other, one or the other is going to happen. We just have yet to see real good additional bias or confirmation now that we've had a decent rally in the S&P 500. Bond yield curve, let's talk about that. That is a very slow moving indicator, but it's also of note where we're at currently, because talking about interest rates is still important and is always important when we're talking about stocks, because interest rates affect stocks pretty quickly in terms of particularly risky stocks or small cap names that don't have as as solid of a cash balance sheet, and they're maybe looking for borrowing more money, and the cost of borrowing really is high when we're looking at current interest rates. But we're starting to see that slow. Part of the issue is dealing with inflation. The Federal Reserve has had to raise interest rates over the last couple of years to really slow down the economy. And now the issue is going to be how much slowing did they actually do? Did they do too much damage? Have interest rates stayed too high for too long? Or on the flip side of that, have they done a fine enough job to manage the inflation, but we still have a very strong economy. So the economy is still chugging along quite well, but whether or not we actually see that into this next earnings season, that's going to tell. I think the next couple of weeks are going to be quite telling on what the Fed's perspective is of the economy and what companies are dealing with in terms of earnings in the last 3 months as well. But we still have that inverted yield curve where we have the 2-year. It's not quite inverted anymore, but it's basically flat. The 2-year is at 4.11. The 10-year is at 4.25. So it's no longer inverted, but it is flat, and it is coming down a little bit. If I just move this over a little and watch this end of the curve, you can see it is flattening. You're kind of getting a little bump there in the middle, a little wiggle on that 10-year and 2-year just over the last 2 or 3 months. And so we are seeing some change in that yield curve. This is the short end starting to come down, long end's kind of stabilizing. That's a good thing. We'll see if we do get some of these economic numbers, or I should say profit numbers from companies during this earnings season. Let's jump over and look at kind of a little the next level where we're looking at individual market indices or sectors from that. We are seeing S&P 500 hovering right around that flat line, but moving back into that hold range. We've seen some support right here at that 572 area, 586 area is significant all-time highs on S&P 500 here as well. But getting some demand, still seeing some demand, some buying happening on these pullbacks. So far, so good today, relatively flat day, but working in the right direction so far. We have seen selling into a lot of the closes. We'll see if that happens over the next couple of hours as well. That's S&P. NASDAQ also showing some strength, potential breakout of some of these recent highs right here. And Russell 3000 and 1000 also showing strength, as well as Russell 2000. Those are your mid and small cap names. Dow Jones Industrial Average had some weakness here, pulling back into that demand location, that support area. But this is when we start to see a potential shift of character or a shift of market structure, when we start to see it go from an uptrending to a non-trending to potentially a downtrend, or at least a deeper retracement into that 382-618 zone. Once we get into this zone, that's still an overall uptrend, and you're still getting demand coming in. It's just at a deeper level. So this still maintains this overall uptrend, but potentially you could retrace all the way back into these areas and still have it be an uptrend, but just deeper retracements. And those are typically more corrective counter-trend retracements versus just natural momentum. The natural momentum range happens in this above this 236 area. And on this 6-month time frame, that's a good time frame to utilize to also see, usually you get a clear enough perspective and enough time to be able to look at that current trend and see which direction that is going. So still have this bullish tone, but getting some weakness here on the Dow. Bonds, this is a concern where we're continuing to see bonds moving lower. That means interest rates are still moving higher. The bond market thinks that the economy is still moving quickly and that inflation potentially could become a concern still, and you're seeing bonds sell off. And you're seeing one of the other talking points of bonds is the discussion that's been coming around about the federal debt, and with the trillions of dollars that we're paying in interest, at what point are we going to run the risk of a default on, and those are kind of worst case scenario discussions. We always have raised the debt ceiling discussions. They're happening more and more often, but one of those risks that's why you're seeing flight to gold as well, because you have a dollar that's weakening, you have bonds that are selling off, you have this perspective that the U.S. Economy's the U.S. balance sheet is in trouble because we have so much debt that we have to pay, and we're paying, as much in in military and defense spending as we are in interest alone on our national debt. It's a problem. We want to close our eyes and bury it, but at some point it's going to have to be dealt with. Bond market is having that discussion right now. So keep an eye on bonds. If they continue to retrace, that's going to hurt the stock market. And we want to be paying attention to see if and when that does start to happen as well. Jumping over to sectors, again, seeing kind of that mixed bag on sectors where we're seeing, we've got two in the hold range, or excuse me, three in the buy range, several in this hold range, and a couple in that sell range as well. One of the things I wanted to go over today, let's look at commodities while we're here, because gold is having another big move today, another % higher. Silver also finding some support, up another %, and USO continuing to sell off, down another % to the downside. So you've got gold and silver moving higher. You've got oil moving lower here as well. And again, gold and silver potentially moving higher for some of those economic reasons that we talked about, and having to deal with debt and the risk of the U.S. dollar, and those are places that you'll see money flowing to. One of the things I wanted to go over is we're talking about this market perspective of looking at the big picture. What's the trend of the market doing? Then we can go in and decide, based on where we're at, what's our position size, how many holdings are we going to have based on cash alone. Current portfolio size is right around 20 to maybe 30% allocation, with about 15 holdings or so. Got some decent winners in there, handful of stragglers that are still coming along there. That's about the position size, and it's about the amount of risk that I'm willing to take right here, and in fact would like to start to whittle that down just a little bit. And again, as far as whittling down a portfolio, you can start out with your losers. If you have some stocks, maybe you've held them for a little while. Some of these we've held for just a few days because they're relatively new trades. Some, like ASTS, which has kind of been lagging here. Our buy signal is sitting right here. It's just kind of chopping around, still retracing, but finding some support. Not quite breaking down, hasn't been stopped out yet either. But those are areas that you can start to trim down the risk in a portfolio, saying, I'm going to sell the ones that have not been performing. I'm going to sell some of my some of my losers, or part of my losers as well. I don't necessarily have to do everything all at once, but I could say I need to reduce this by 10%, going from that maybe a 30% allocation back to a 25% allocation. And that could be one way to be able to do that, is start to whittle those down, and also taking some money off the table on your winners as well. And otherwise, in really good market conditions, you start to build a large number of holdings, and that's kind of the point. When market conditions are working, we want to have larger allocations, but as they start, as we're at the kind of the top end of this range, we don't necessarily want to get this push higher and end up with too many holdings if we do get a reversal right here. So these are ways to just be able to manage the risk with the bulk in cash still versus in other assets. Typically, when we're talking about portfolio management, we're talking about individual stocks or ETFs and cash. Okay, so you could certainly include some, maybe, bond ETFs or some other things in part of this allocation as well, but we're talking primarily about individual stocks and cash. That way you know what you're getting out of the cash for the most part. You're not having to worry about a return on that. Am I trying to get return out of bonds? Am I trying to get return out of other interest-bearing type of accounts? Cash works great for that allocation. Particularly right now, it's still paying a decent amount, and so that's kind of the holding that the overall holdings that we're looking at. Now, in terms of adding into a position or adding into a new stock, can start out with the new buy list. The new buy list is pulling from the entire database, and you can look down here at the bottom to see what that screen criteria is. $2 or higher. It's gone from a hold to a buy, which means essentially it's gone from a non-trending state to a trending state. Anytime we're in this buy, we've essentially just moved into momentum or back into momentum. So sometimes you'll go from, back and forth as it's trying to chug along and find that overall direction. But that's essentially what the signals are based on, or have we entered into a momentum type of location here as well, versus or a momentum characteristic, momentum structure of the market versus a non-momentum or trending or downtrend as well. So, but there's a lot of stocks in here. Say, I don't want, how can I really fine tune this and say which stock may I want to have if these are the conditions that I want, but I want a little bit more refinement on that. I can go to the screener, one of the screens that I've got here. So you're going to get these basic settings. These are some basic fundamental type settings. They're not all fundamental settings. Most of them are just based around earnings. Okay, you've got sales, you've got earnings per share at last quarter, earnings per share year over year. Part of the reason why is we're focused on the growth of the company. Okay, we're focused on the cash and the earnings primarily. The other factors that are coming in, when you're dealing with cash flow and management and product mix and dividends and do we have this EBITDA or that or all those different things, that's really not the type of analysis we're focusing on when we're looking for fundamental scans. We're primarily focused on the growth, and that's coming from the cash, and that's coming from the earnings per share. And obviously, we need sales to go into the earnings per share. And from there, as earnings per share are increasing, then then you can kind of deduce some of the other factors that, the debt load, the management side of things, they must be doing what they're supposed to be doing. Not always, but in terms of the most important factors. Then from there, we want to know if we're in momentum or not. So this indicator, we can say this momentum value, the max is it goes up to a larger number, but at 140, you're not extreme. Okay, so this is going to pull in now stocks that have a market cap of 100 million. That's still relatively small. I could increase that as well. Volume is 500,000 shares minimum. And then these factors, I call this scan the 555 hold to buy, just because I've got ROE, annual earnings per share, last quarter, and sales all 5% or higher. So not huge, but all trending higher or higher than at least 5. And this has a long-term trend up, and it's gone from a hold to a buy. That's going to really narrow down the selection in a lot of these names. Okay, now there is an increase. I didn't add increased volume in there, which there certainly could be, but these are going to be some high quality names that are in momentum, that have good fundamentals, or at least growing fundamentals. So let's take a look at one right here, which is Trip.com. So Trip.com, as of yesterday's update, it had a new buy signal, meaning it has gone from this hold range back into momentum. Okay, so we're back into this range of the chart and this part of the trend. Now, we obviously can't tell the future, so we're not going to, but we are going to look at what is the momentum. And that's the point of the momentum, is it's starting to move this direction. Market participants liked it. There's a lot of volume happening here. We get a retracement pulling back to some level of support. Okay, the first level of support, this 236, is typically our momentum zone. Oftentimes, we don't even get a trend structure shift in momentum. Sometimes it does if it's down towards the bottom, meaning it hasn't gone from this bullish trend back into this hold range. It'll just stay green the whole time. Not always, but oftentimes it will. Once you retrace deeper into these next levels, 38250, 618, 382. All this means is that we're retracing this trend. If I were to draw this high and this high, from here to here is a 100% retracement. Okay, that means we've retraced all the way back to where we started. If we've retraced here, we've retraced 23% of that. Here, 38%. Here is 50%. So this 50% is halfway. So we've retraced exactly half of this trend. 618 is the 61.8% Fibonacci retracement zone, and that 618 ratio is also referred to as the golden ratio. If you do go out and do a Google search on the golden ratio, you're going to find some really fascinating information, but it works very well for proportional relationships. And oftentimes you'll get a stock that's in a deep enough counter trend, it'll just stop right here and it'll still continue that overall trend. It's removed all of the selling, and now you have new demand that's coming back in inside of anywhere inside of these boxes. The stronger the trend, the sooner the box is going to react, okay, or the price point is going to react around one of these levels. So in this case, we had a reaction around this 382 level, and now we're back up into this zone. So if I were to say I want to buy this stock, the next step on this is going to say, well, I've got to determine my risk. And I can determine that by doing two things: my position size and my stop loss. Okay, so in this case, we're managing the risk with position size at about 2%. Okay, so if I have a $100,000 account, I want this number down here to be around 2%. So first, I've got to see how we're around $65 a share. 100 shares obviously is going to be too big of a position. That's putting 6,000 of my 100,000 into the trade. That's too big of portfolio at risk. That's not including my stop loss. So here, if I said 50 shares, that takes me down to 2.7. That's still a little bit high. Okay, 40 shares is 2.21. That's definitely in the neighborhood. 30 shares, 1.6. That's a little low. Okay, so let's go to 35, 37. Let's go to 36 shares. 36 puts us right at 2%. Okay, so now of my $117,000 portfolio, I'm going to be putting 2,300 into this one stock. Okay, so that's called position sizing, and that is the number of shares. How big of a position am I of my entire portfolio that is allocated towards stocks? How much of that am I going to invest into this one stock trade? Okay. That doesn't mean how much would I lose or how much am I risking in terms of a stop loss. This is just flat out position size. Okay, how big of a position do I have? In this case, 2% of my holdings. This might be small. This might be too small for some traders. If your account is, maybe 10 or 15,000 or even smaller, you might need to go a lot bigger than this, maybe 5 or 8% portfolio size to really get a dent, to really start to make a dent in things. Now we want to have a stop loss included as well. The first place to locate your stop is below the low point before the most recent buy signal here. So I could take this low and say, I want to have a stop loss here. That means that if I buy right here and it retraces and moves all the way back down to this location, to this low point, something's broken with this current trend. It's not doing what I would anticipate soon enough. So I don't want to wait around and see if it's going to do it. So I'm going to stop out of that trade or sell the stock. Okay, stopping out just means I'm setting a limit, a line in the sand that says I don't want to go any lower than this price. If it does, I'm going to exit the trade just to continue to manage my risk. Okay, it might bounce and go higher. It might not. It might sit there. It might go lower. I don't care. The stop out is a part of your trading plan and you have to follow that in order to maintain your trading plan, because you're preventing more losses. Okay, a stop loss is simply preventing more losses. You want to set an area where you're going to have a certain loss that's acceptable, and then anything lower than that is unacceptable. And so you're preventing more losses by placing a stop loss. So 57.50, let's call this 57.50. Okay, and just looking at that right there, 57.50 is my stop price. Okay, what that now does is that adjusts my portfolio at risk. So now I have 2,300 at risk. I've got the trade amount at risk now is 11%. So if I'm stopped out at this number, 57.50, I will lose $277 or 11% of this trade. Okay, so this is now got the two parts, the portfolio at risk and the trade at risk combined. So of my entire 117,000, I'm risking 0.24. Okay, that an acceptable level for this portfolio management trading plan is 0.2 to 0.3, so somewhere in the middle, which is usually around $200 to $300 at risk per trade, including your stop loss and your position size. Okay, now you just got to pull the trigger. Now you got to go into your brokerage account and say, I'm going to buy this stock today with a stop loss at 57.50. Okay, so let's look at what was the symbol on that one? TCOM. Okay, so this is Webull, TCOM. It's going to pull up this chart. It's going to look like this. Again, one of the reasons I do like this is you can kind of drag and pinch and pull the chart to give you kind of that perspective that you may want. And you can set it up using just a very simple buy order on the screen itself by using a first trigger stop as well. I can just select buy. Okay, now again, we're setting these up. I could set it up right now. I could set it up pre-market as well. Typically, if it's pre-market, you're going to determine a limit price and then a stop price. Okay, so I'm going to go here all the way down to my stop. We set at 57.50. Now I can also set a target as well. Okay, now this is called a bracket order, and I've done it all in one click. I drag it, set it up, and now I just have to place the order. Typically, though, on these trades, most of the time, we're not using a target in advance. We're using a trailing stop, and then we're going to use a percentage exit when we hit a certain level. But you can leave that in there as well. And if you wanted to have just a target, you're buying, you've got your stop loss, you've got your target. If it hits it, you're out. You know, that's another strategy to utilize as well. You're just capturing those gains while you've got them versus trying to get a little bit more out of the long-term approach of the stock. So now you're set up. You click the buy button. Your stop is in place. You go back in tomorrow and you say, okay, has it gone higher? Has it gone lower? Is it inside of this red zone? This is my allowable risk. So I want to be okay if it's doing this. The second it gets down to this point, this order inside of my brokerage account is automatically going to fill, and it will automatically sell for me. So there's obviously nothing I have to do there, but each day I want to see, is this okay? Or have we moved high enough that I can now adjust my stop loss higher, which is another function of utilizing a trailing stop loss. We can use that with the 236 area as well. Okay, so let me give you just a quick example of that. If we were to look at one of our holdings, Palantir, okay, and we were to go back to maybe this initial breakout day. I believe this was the initial buy point here. So a day that looks like this, you're saying big volume, confirmation bar, increase. I'm going to buy it on the next day. Okay, here we're in the trade. I've got a trailing stop loss. Initial risk stop loss is probably a little deeper down below this area. But once it starts to trail higher, we go another day. Okay, a couple of days, you can see that this bar is just connected to that high point. So it's pulling this number up. At this point, we can probably adjust our stop loss. We haven't had a real retracement at all yet. Typically, you want to wait for at least one retracement and then adjust, and then you can trail that stop higher. So now this becomes our line. If we want to go in and change that every day and say, what's the stop loss? Typically, it's not needed every day. You kind of want this high watermark. Unless it keeps moving higher aggressively. Okay, you can see there now we got another big move higher. On a big move like that, you could just start to trail that stop loss a little bit higher. Okay, now we're just, as long as you're continuing to move higher, at some point you're going to, dance around here, have some volatility, potentially even stop out. But now we've gone from here to here with that trailing stop, selling into the strength as well. Our trading plan is for selling 25% of the holdings at a 20% gain, okay, and then another 25% at a 50% gain. So on Palantir, we've actually done that twice now. We've sold into strength at 25, sold into strength at 50%, and now we're trailing the rest of the shares and seeing what we can get out of it, how much higher it's going to go, allowing for essentially this much volatility, and also allowing the possibility that we may get stopped out in return for the possible reward of even more upside. Okay, so at some point we have to be okay if we're using a trailing stop method to have this amount of volatility. Remember though, we sold into strength, and now the rest of the shares are using, let's see what, it's called a runner. Let's see what we can get out of the rest of these shares. Maybe it goes crazy and really takes off. We have had some big winners over the last year just by continually holding on to those that are working. I'm going to end on that note. I appreciate everyone's time and effort, and we'll see you next time. Have a great day. Bye now.